Hello and welcome to the 6th episode of Intimate Investing. This is going to be a slightly different video this week, both because I'm actually being videoed this time and also because it's not a portfolio update as it usually is. I decided not to do a portfolio update this week because last week I didn't make a single allocation. Now times like this happen. The reason for this time, I actually had to replace the clutch on my car as well as the master cylinder. I'm really not a car person myself. That doesn't mean a lot to me, but it was quite expensive to fix, despite me getting somebody I knew to do the labour for me for a very good price. The part itself was quite expensive as well, and altogether it came to maybe about £300. And typically my investment allocation each week is around £300. Sometimes it's closer to 200, other times it's closer to 400. However, I really didn't feel comfortable still making an investment despite having quite a significant outgoing last week. So therefore, I haven't made a single allocation this week. It's certainly not a bad thing. The markets, they've risen quite a bit. They've recovered quite a bit since their massive dip. So it's really not too much of a problem. I do have this suspicion that there is going to be another drop at some point in the near future. And obviously, I never recommend trying to time the market. But when you are quite certain or have quite a hunch that there is going to be a drop, it's really not the end of the world to miss a week of investing. We'll take the S&P 500 fund that I invest in, for example. This is now recovered to the extent that it was prior to the fall. So while there definitely is gain to be made, and it definitely will appreciate over time, those immediate gains are no longer there. Therefore, I don't really mind not having the allocation put into my portfolio this week. I'll probably double down on them. I'll do a slightly bigger investment next week. Probably not too big. Certainly not double my usual allocation. I'll maybe try and put in £400 or £500. That'll take it to around the 3,000 mark for the entirety of the portfolio. So yeah, this week instead, I've decided, I did mention in one of my previous videos that at some point I would go over my general investment plan and what I intend to achieve this year. Now I'm 21 years old. This is the first year that I've invested. I've held shares in the past, although it was never anything significant. I'd be sort of buying them on a whim while I was researching investing. Usually make a small profit and then I would sell them later. I would get bored of investing. I wouldn't be keeping track of the stocks, etc, etc. I also bought Bitcoin quite some time ago. Again, that wasn't long term. I didn't hold on to it for very long. It was sort of spur of the moment, and then quickly came to my senses, realised that I didn't have the time dedicated to actually investing to make it a smart decision. So yeah, this is essentially my first year of proper investing. And now my goal for myself are actually, they're quite difficult to achieve in my current employment and sort of my financial situation. But I do think I can manage it. Now, my intention is to get to 18,000 in my stocks and shares ISA by the end of the tax year, which is April, running until April. So this is going to be quite difficult to achieve. I would like to sort of max out that 20,000 in the ISA. I think that's just slightly out of bounds for me in my current situation, unfortunately. So I set the bar at 18,000. Now I think that means you need to be allocating on average, I think it's £343 or something around that number in order to achieve the 18,000 at the end of the year. So what my plan for that £18,000 allocation? Obviously, it's not going to be balanced the entire year going through. Fractional shares, they have made that easier to do if I wanted to just have a set allocation for each stock or fund per week. However, things don't always work out that way. Sometimes a stock will drop significantly. Sometimes the other one that I was going to buy will have a brief growth in it and makes it a little bit less attractive to buy. Therefore, I don't really mind how my allocations and my diversification is throughout the year, as long as by the end of the tax year it arrives at the point that I want it to. Now that really is the mindset that I think others should be taking as well. Right now I'm far overexposed into oil and finance. However, that doesn't really matter because in the long term I know that will not be the case. So out of that 18,000, my intention is 6,000, so a third of it will be going into dividend stocks. Now, UK investors, they are sort of, I don't know, they're more likely to be focused on dividends. Obviously, our large cap index is the FTSE 100, and while these stocks don't they don't deliver the best performance growth wise, a lot of them are sort of older sort of industries where the growth potential isn't quite so much as in, say, United States tech. However, they do have a strong history of paying dividends, as does the actual FTSE 100 itself, because of all those companies that are dividend payers being a part of it. So in that, out of that £6,000 dividend stock allocation, it's split between the sectors for me. There's some sectors that generally they pay better dividends and they have a better history of dividends than others. So the ones that I focused on, I'll quickly run down the sort of the sectors first, and then I'll break down the companies between those sectors. So insurance, banking, mining, oil, telecommunications, possibly also moving on to pharmaceuticals as well as energy. So for the banking stocks, no, sorry, I'll start with insurance. Insurance was the first one. So for the insurance stocks, I went for Aviva and Legal & General. Now, these are both insuring companies, although I have picked them because they do specialise in slightly different areas. Aviva is it's a lot of general insurance, life insurance and things like that. But with Legal & General, they're more into sort of business sort of insurance as well as general insurance as well. Now, I mean, these are both solid stocks, and when I have started to buy them during this dip, they do provide a very good dividend yield. And I do imagine Legal & General especially, they have a history of increasing their dividends over the past few years. I do think that will continue. Aviva as well, before the dip, they were sort of trying to allocate money to pay down debt as well as increase their dividends. So I also hope that they increase theirs. Although at the price that I got them both at, I think they're both solid stocks. The next one's banking. So for banking, I'm quite heavily invested into Lloyds at the moment. I've got about 900 shares in that. I'll also be taking HSBC into that industry. Now again, there is a slight bit of diversification between these two stocks, despite them both being in the UK banking sector. And now that's mostly because at Lloyds, they focused almost primarily in the UK, so they very accurately reflect the state of the UK economy. On the other hand, HSBC is very Asian orientated, so then again you do get that added small element of diversification despite them both being in the same industry. With Rio Tinto and BHP for the mining ones, I mean, they both differ slightly as well. I can't remember the exact they differ in which minerals and which sort of precious metals they take out of the ground. So I mean, if there's a dip in one precious metal or one commodity, and not a dip in the other, then it also means I've got a sort of hedge against that. I don't have all my eggs in one basket. So then for the oil majors, it is Shell and BP. Now these, I mean, there's not too much diversification to be had here. They're both just stocks that are sort of, they're big oil majors. They're very, very strong companies, fantastic dividend history. And I mean, they don't differ too much. They're both sort of looking to the future. They both intend on being quite green focused in the coming decades. And I do think they have a future even beyond oil. So the end of oil, that doesn't concern me too much in the long run, especially since I have got these shares at a decent price with a relatively high yield. So even if there is a cut, which I mean there might well be, I mean they're commodities based stocks, so if there's a dip in the commodity price for a significant period of time, those profits are going to tumble. But again, I mean, if things fluctuate, and I do think that oil is still a significant period of time until it's past us. So I do believe in these stocks also. So the next industry is telecommunications, which is Vodafone and BT. They've both taken quite a hit the last couple of years with their share price. I do think that's beyond them. We've got 5G here. BT have their Openreach programme. And again, there's diversification to be had within these two stocks as well. Obviously, British Telecoms, surprise, is focused very heavily in the UK. I mean, they do have sort of operations elsewhere, but Vodafone, on the other hand, they are very, very heavily into sort of the European market, as well as a lot of other markets as well. I mean, there's a lot of African countries and things that they are quite heavily involved in and growing overseas. So again, there's the diversification there, and I do think that is a really important thing. As you can probably tell from my allocation in the dividend stocks, there is sort of like an opposing force for each of them, and that is a very, very useful thing to have. I mean, having two stocks is good. I mean, at least you're spreading your eggs between a couple of different baskets. But when those two stocks actually specialise in different areas or in different geographical areas, then it does give you that added confidence. So the next two that I haven't actually added into anything yet, I mean, I'm potentially going to move into pharmaceuticals for my dividend stocks. Now, the one that really caught my eye was GlaxoSmithKline. Now, they pay a dividend yield of about 5% at the moment. I mean, it's been growing steadily. I mean, it's not the best yield in the world, although I do think they're quite a decent growth stock as well. Especially in a time like this. I mean, there's going to be a lot of vaccines and everything getting rolled out, hopefully, in the coming, I don't know, nobody knows how long, months, years, half a decade maybe. I mean, we don't know. But even if it isn't GlaxoSmithKline that actually come up with that vaccine, they are a major player in vaccines as is, like currently. So, I mean, they could still aid in the production of that vaccine, and I'm sure that would aid in their business as well. I'm not sure the second one. I mean, as you can see, I always stick two stocks into each industry. I'm not sure what the second pharmaceuticals industry dividend stock would be. Although I mean, it is kind of going against my approach here, but I would even sort of put half of the money into GlaxoSmithKline, and then AstraZeneca, that could have the other half. So while AstraZeneca, it isn't a dividend paying stock. I think they do pay a dividend, but it isn't very substantial at all. They are probably one of the better UK growth companies. So despite that being included in my UK stocks, which my UK stocks are only dividend stocks, they just don't have the growth potential to pick any for their growth compared to the United States. But I wouldn't mind having that one UK stock that is primarily geared towards growth in my dividend stock portfolio sort of area. That would be fine with me. I mean, I know that I get the dividend from GlaxoSmithKline, and then AstraZeneca, I do think, I mean, there is the growth there. So that could be the one outlier in my dividend sort of industry breakdown. And then the final one is energy. Now, I do want to take a position in SSE and probably National Grid as well. I think SSE have a dividend yield of about 7.5% currently, and National Grid about 5%. There is a dividend cut coming from SSE in the following year, unfortunately, but I mean, it is still a decent enough dividend. The only thing that concerns me with that industry is that there's a lot of newcomers, sort of smaller companies that are focusing more on green energy, and at least in my geographical area, they're actually beating SSE significantly on their price per kilowatt. Now that really is quite concerning, the fact that these small newcomers are able to compete with such an established company. So that's the only thing holding me back from taking a stake in the energy industry. However, I will be monitoring that as time goes on, and I'm sure I will pull the trigger at some point. So that's gone over the dividend growth stocks. I mean, there's 6,000 going toward them. Each of the industries, it's going to be split down the middle with half for each of the stocks. So 50% Aviva, 50% Legal & General, 50% Lloyds, 50% HSBC. So the next one are the indexes, the ETFs that I'm going for. And there's going to be £7,200 allocated towards them, which is 40% of the 18,000 allocation for the entire year. So of that, there's going to be £2,500 being allocated to the S&P 500, which is an iShares fund that I hold on Freetrade. There's going to be £2,500 going to the US tech sector, which is it's a fund which essentially is the Nasdaq. It allows me to dollar cost average a little bit more and ease into my position, which is why I've chosen it over the Nasdaq. They've got very, very similar holdings, almost identical performance, so I'm very, very happy with it. So that's the US indexes. After that, there's going to be £1,100 allocated into the FTSE 100, and then £1,100 allocated probably to the FTSE 250. Although this could be a totally different fund. I'm set on the FTSE 100, although that FTSE 250, I'm not too sure yet. I don't know if I want more exposure to the UK market, as it is represented at the moment. So that could even be a world tracker fund or something like that. So don't hold me to that one. That one is undecided as of yet. So yeah, that's £7,200 of the 18,000 going to indexes, 40% indexes. And then the final £4,800 of the portfolio will be the US growth stocks. So as you can see from my portfolio updates, the likes of Apple, Amazon, Microsoft, Facebook, Berkshire Hathaway, Visa, MasterCard. I'll probably be adding Nvidia soon. So sort of stocks like that, blue chip, sustained growth stocks that I can trust to grow my money. So that's the £18,000 allocation plan as is. I mean, it's going to differ slightly, and there will be small alterations made to it. Like there is going to be some sort of wild card allocation. So if I think a company's going to do well, like in the case of Uber, or if I buy Carnival, or if I buy Boeing, United Airlines, EasyJet, these ones are sort of wild card investments for me. I don't think any of them would ever go over sort of £100 if they are a wild card, and I'm not sure of myself. But there certainly will be allocations for stock like that I do have a strong feeling will rebound quickly, or even sort of IPOs and things like that. I mean, I do intend on having small allocations for that, although it is not being factored into my overall investment plan at the moment. So I hope that gives you a good sort of idea of what my intentions are, what my goals are, and what I intend to do with this first year of investing. Now, I might not achieve that 18,000, I might overachieve it, get the 20,000, I don't know. But I think 18,000 is a good set sort of metric that I want to get to and I can aim towards. And I do think that allocations at the moment, I mean, they're going in that direction. Obviously, I've got a lot of dividend stocks at the moment. I do have a lot of sort of in finance and energy especially. But that is going to change. I mean, it'll be gradual. It'll be throughout the whole year. We're only sort of, this is the end of May. It's almost June, April, May, June. So that's 2-3 months it's been since the start of the tax year. So my portfolio is going to change a lot over the coming months. And I think it will change into that sort of structure, although I just don't know. My first year of investing, it could well differ significantly. We are just going to have to see. But I hope you've enjoyed listening to what my overall plans are. I hope it's given a good bit of insight and perhaps even helped in your investment decisions, help you plan what your goals are. And yes, I hope you've enjoyed, and I shall see you next time.